Hello, and welcome to the Association of Catholic Publishers webinar called Getting Your Staff Invested in the Financial Efficiency of Your Organization. We have Patrick Markey, Executive Director of the Diocesan Fiscal Management Conference, joining us today. My name is Joe Wires, and I'm from Ministry Training Source, and I've been asked by ACP to coordinate and host these events. On behalf of the Board of ACP and as Executive Director Therese Brown, I bid you good afternoon, good morning, or simply good day, depending on which time zone you are in. A few housekeeping details. As is standard with webinars, participant, your audio video is currently muted, so all resources can be directed towards Pat. During the presentations, I will also mute my own audio and video, but I will be watching the chat and answering any questions or sharing those with Pat as we go. Upon completion of this webinar, GoToWebinar automatically loads a short evaluation interest finder form. So please take a moment to complete this so we can consistently improve our product. A question will invite you to name some additional topics that we may address in future webinars. So today, as I said, we have Pat Markey. He's the Executive Director of the Diocesan Fiscal Management Conference. He was formerly Executive Director of the U.S. Office of National Collections. Before his work running the National Collections Office, he worked 15 years in Catholic publishing, including as Marketing Director of USCCB Publishing and publisher of New City Press. His early professional years were in investment banking. He is a certified public accountant and holds an executive MBA degree from the University of Loyola in Baltimore. He has served many Catholic and other not-for-profit organizations and currently serves on the boards of the Center for Ministry Development, New City Press, and the John 17 Movement, and he is a consultant to 2 USCCB subcommittees. He comes from us live from Phoenix, Arizona, and Pat, thank you for joining us today.
Thank you, Joe, and thank you everyone for joining me today. I'm real excited to be doing this. I spent a lot of years in Catholic publishing, so back when it used to be called CBPA, so I'm really happy to be back with everybody. So thanks. So today we're going to be talking about getting your staff invested in the financial efficiency of your organization. So that's the topic, and we'll see what we can do to get a lot of it done. I was told by the ACP that we should be talking about the financial condition of your organization, the goals that need to be achieved to improve, maintain, and grow your organization, and then strategic planning for your organization's future. So we'll be trying to hit a lot of those topics. In the meantime, Therese Brown did ask me to first cover what I will call business basics. And so she asked if I could spend a little bit of time talking about some of the fundamentals of business and then transition into some of the other areas. So I'll spend a good portion of the first part of this conversation on what I consider business basics. And then the other part will be more of a higher level than I had originally intended, kind of a view of a higher viewpoint, kind of at a managerial level or a leadership position. And if needed, maybe later we can drill down into some of the details of that, but hopefully we'll give you a lot of value today. So we'll go right into it. So I'm going to start with the polling question, because I'd like to know of those attending who you are and what your positions are at your organization. So I'm going to go ahead and ask Joel to run the first polling question.
You should be able to see it in front of you on your screen there.
So while Joe's doing that, so I say we're going to be talking about business basics. And the reason I call it business basics is because I don't want to scare anybody, because actually we're going to be talking about accounting. I am a CPA, and that's what I do. So we're going to talk a little bit about accounting, but I want to do it in a way that shows you how and why it's important for the success of your organization. So now Joe's going to share the polling results.
They should be up on the screen. Pat, are you seeing them?
I'm not seeing them, Joe.
All right, so we have 40% are in the publisher director field, 20% are business HR manager, 20 is marketing manager, and 20 is production manager.
Okay, good. So that's a really good mix of positions. And so I think, and it's all sounds pretty high level. So I think what I'm going to give you is going to offer a lot of value. That's our goal for today. Okay, so like I said, I have to be completely honest. This is about accounting. It's kind of my version, Pat Markey's version of Accounting 101. So once upon a time, I was in an executive MBA program at Loyola, and I was with some of the smartest people around. I mean, there was a doctor who ran a pediatrician unit in a hospital. She was brilliant. We had lawyers, we had bankers, we had a real estate developer who was a multimillionaire. I mean, these were really smart and successful people, and all high achievers. When we got to the accounting class, all of them had trouble. Nobody could pass. I spent so many evenings teaching them accounting, and I couldn't understand why it was so difficult for these really, really smart people to understand the basics of their livelihood, of their businesses, and what they were doing. And so what I determined is that they were going about it all wrong. Somehow people think that accounting is about mathematics, that it's about math. It's actually much more philosophical. It's not about math. People become accountants because they can't do math. If I could have done math, I would have become an engineer or a doctor or something else. But because I couldn't do math, I became an accountant. Because it's not about mathematics so much. Accounting is about value, trying to understand the value of something, and trying to understand the timing of when an event happens. That's it. That's what accounting is about. It's about value, it's about timing, and it does not involve mathematics, at least not too much. So there's a standard definition, so I'm going to put that on the screen. And so the standard definition that you have is that accounting is the art of collecting, recording, classifying, and summarizing business transaction, and then finally preparing financial statements. So it's about understanding, pulling things together, understanding where the business is at in its day-to-day operations, and then showing those, presenting those in a way that other people can understand them and use them. And then the purpose, the standard definition of the purpose of accounting is that we provide information for decision makers so that you can make proper economic decisions. So I would like to say that accounting, if you're going to be a successful organization, you better have proper accounting and you better understand, I think, what I'm about to tell you about. So the second polling question is, how do you feel about accounting? Do you love it? Do you see it as a necessary evil? Are you indifferent to it? Is it too much trouble, or do you just plain hate it? So I'll ask Joe to open up the next polling question.
You should see it there. And real quick, while we wait for everyone to vote, you have some fellow kinship. Few people, or someone mentioned that she also went to Loyola and remembers that accounting class very well. And we'll give everyone a few more seconds. Okay. 25% see it as a necessary evil. 40% see it as a necessary evil, and 60% are indifferent, Pat.
Okay, so maybe today I will change your attitudes, or at least help you to think about it a little bit differently. Okay, so we're going to drill down a little bit into that definition of accounting. Like I said, it's not so much math. Otherwise, we would have been engineers and doctors. So it's about these things that you have on the screen. Whether you're a business, you're a not-for-profit, you're a church, any organization needs to know these things, and this is what accountants try to figure out. So we try to figure out, these are what we call the fundamentals. There's actually about 10 of them, but I narrowed them down into these things. So we try to figure out when something happened, an event, whether you sold something or you're going to sell something, or some kind of a transaction took place. And that's not as easy as you think. So accountants have rules and ways of kind of figuring that out. And then we are very concerned with value and measurement. People think it's really clear that something has a certain value, or it's really simple to understand what that is, but actually it's not. So if you might remember back in 2000, there was a company called Enron And there was their accounting firm called Arthur Andersen, and they got into a lot of trouble. And they destroyed a lot of people's lives with their activity and what they did. And what it boiled down to was they had a new product. They were selling energy, somewhat in the same way you would sell a stock or a bond on a market. And the problem was is that it was something rather new that they created, and it wasn't clear how that would be valued. And so they, with their accountant, came up with a determination of that value that benefited them. And so therefore it was incorrect in its valuation. And so it turned into a lot of, among other misdeeds that they did, very problematic. So it's not easy to measure value, but it's fundamentally important for the success of a business. So having said that, accountants tend to be very conservative in nature. We do what we call the cost principle. We try to base value on something tangible, not so much on what you might think the value might be, but on something that we can pinpoint to a time and a place when that happened. And we're also concerned about something that's material or not, meaning if it's really small or it's insignificant to your business, let's say you have a multi-million-dollar business and some things happen that are what we would call immaterial, they're small in amount. We don't spend a lot of time and energy on those. We worry about the bigger things. And then we're all concerned about how we report that out, who's going to read it, who's going to understand it, and what information needs to be shared so the decision makers can make their decisions. And finally, if you can't get this all right, your organization will not be there in the future. So we're concerned about going concerns. Okay, so here we go. There's two ways to look at accounting. You can either look at it on a cash basis, meaning that if a transaction happens and something takes place, then that's all you're concerned about. So you're maybe worried, are we profitable? Was this in a certain period? Or do we have any money? So if you're on a cash basis, those are your concerns. And it's very short-sighted and it's quite limited. So accountants don't like that process because it's not helpful. It's only helpful in the present moment in current transactions. But accountants, in order to do those other things that were on the other page, we need to use a different methodology. We call it an accrual basis. And this is where we're trying to match times and events. And so these accrual basis looks at what's the future. What is the future of our organization going to be like? Are we going to continue to be a going concern? Can we make a plan that we can depend on? Can we project? Do we know that we'll have any money tomorrow? Can we borrow money from a bank without getting into trouble? And can we manage our inventory? And the only way you can answer all those questions and understand those things is what's called the accrual basis of accounting. So if you're not worried about those things, then your business isn't going to survive. If you're working on a cash basis, which a lot of not-for-profits do, it's not a really good way to go about things if you want to plan for the future. So I said that we don't do math, but we do a little bit of math. So for an accountant, and I would say for anyone who really would like to understand business and be successful in business, this is your formula. This is what matters. This is what accounting is about. It's about assets equal liabilities plus equity. That's accounting. That's what matters most. If you use this, you don't only have to worry about what's happening today, but you can actually plan for what's happening tomorrow. So if you worry only about today, then you're going to be focused on your income statement and you're going to be focused on your budget. And that's a short-sighted way of going about it. If you want to be thinking about tomorrow, you're going to focus on the balance sheet. Assets equals liability plus equity. So I want to spend time on going into this balance sheet, into this formula of accounting, and show you why it's so powerful. This is accounting. This is it. So if you understand this formula and you can really understand what it's about and how it works, then you have a very, very, very powerful tool for your business and understanding any business. If you want to figure out the value of a company, the value of some going concern, this is what you need in order to do that. And if you can figure out how this works, it tells you volumes about any organization. So I want to talk about this and go into it and help you understand why it's important for accounting. So the first question is, on the left side of this formula, it says assets. So what's an asset? So an asset is anything of material value to your organization. So that could be cash in the bank or in an investment pool. It could be people that owe you money. That's called a receivable. Could be inventory, your books, or any other kind of inventory you have, machinery, all of those things, including maybe you paid an expense ahead of time. That's called a prepaid expense. That's actually an asset. That's a value to your organization, something that adds value to who you are and what you do. So that's the left side of this formula, assets. And that equals the other side of the formula, liabilities and equity. So let's look first at what liabilities are. So liabilities and equities in general are any claims against your organization. So they're things that, like an accounts payable, you owe somebody money, or you have a debt, you took a loan out at the bank, you've got money that you haven't earned yet, that's called an unearned revenue. So you have a liability towards somebody else for that transaction that hasn't taken place yet. Maybe your wages that you owe to your employees that you haven't paid yet, taxes that you might owe. Those are liabilities. Those are things that are claims against what you're doing in your organization. So assets equals liabilities plus equity. I'm going to get into equity in a minute, but first I want to concentrate a moment on assets and liabilities. So assets and liabilities, if you look at a balance sheet, then they are divided into short-term and into long-term. And the reason accountants divide them into short-term and long-term is so that you can understand if your organization is viable and what you might do if it's in trouble. And this will tell you that. So short-term assets and liabilities are those things that are either liquid, meaning the cash, it's on hand, it's something that you have available, or it's within a year. So on accounts receivable, normally 30 days somebody should be paying you. That's a short-term asset. A liability, normally your accounts payable, you have to pay somebody in a year. That's a short-term liability. And it's very important to understand in the short term what you have and what you may have to give somebody else in order so you can figure out if you can make it. Can you pay your employees? Well, then you need to understand if you have the cash or if you're going to have the resources available to meet that short-term liability. So that's divided up so that we can have a clear idea of the health of our organization today. The other thing that this formula tells you on your balance sheet is long-term. So long-term we divide out in another way. So we say there's some things that we're going to have a value that are longer in nature. They're not liquid. So if, for example, if you own a building, if you want to have cash out of that building, then you're going to have to sell it. That's a long-term prospect, or that machinery that you have. So we call those long-term assets. They're for the long term. Or maybe somebody owes you money, but it's a 10-year note. And so that would be compared against those liabilities then in the long term. So in the future, where do we stand? If we have a lot of debt that's going to become due at one point, then we have these liabilities, then how are we going to meet those liabilities in the future? So we will need some kind of longer term asset. So accountants like to match those and try to understand so we can plan and we can figure out if we're going to be a going concern or not. So I say this to say that this balance sheet is a living document. It's something that's happening all the time. It helps you to understand, you do it at a certain date. So a balance sheet is of this day today and tells you in a snapshot where you are and where you can be tomorrow. So I would like to prefer to call it a living document. Okay, so now we're going to go down a little bit more into this document. So I said assets equals liability plus equity. So what's equity? For a not-for-profit organization, we would say it's net assets. And so I'll explain a little bit what that means. So in a not-for-profit or for church organizations, a net asset are all of those. We all rely on donations. So we need people to give us money so that we can do the things we need to do and meet the obligations that we have. And so those net assets with liability equal the value of your company, your assets, what you have. So it's those two things together. If you're in a for-profit company, equity would be owner's equity. It would be the stock or that initial amount of money that was a business started with or an organization started with. That's called owner's equity. That's how you bought all those assets. That's what you came into this equation with. So it's always an equation, and its assets equal these things. So if I had $30,000 to start a business and I bought some equipment, then that equipment equals that original $30,000, and that's my balance sheet. And so that's called owner's equity. And then on a going concern, I have what's called retained earnings. So over time, hopefully I'm making money, right? And so that's my profitability. And then that's also maintained in what's called retained earnings. So that's the right side of that balance sheet. Okay, so from here, we're going to get to the famous income statement, which most people, in my experience, focus on. And I would like to say that's a misguided focus. You should be focused on the balance sheet. You should be focused on the big picture. And then you should put your eye on, did we make money this cycle or not? Are we profitable or are we not? So the income statement, or in the not-for-profit world, it's called a statement of financial position, is just part of this balance sheet. It offers a detail about your organization. It tells you how your operations is going. So it's important to understand it's the context of a greater whole. And on its own, it does not give you enough information. It's a historical document. Whereas I said the balance sheet is a living document, the income statement is a historical document. It tells you what happens. How did operations go last month? How did they go last year? So that's the income statement. So I want to drill into this a little bit. So, and I'll stop for a moment and say something about budgets. So in a not-for-profit world, at least in my experience, when I was at the Bishops Conference, we always focused on the budgets, the budgets, the budgets. The budget is a managerial document. So a budget is a way to govern an organization. So a board of directors, or in my case, the bishops, decided how much money they wanted to have and how they wanted to use it. And so that's a budget. And then a manager uses that to determine if the staff or if the organization is doing things correctly and efficiently. So the budget has a role, but it's a tool. So we can't become slaves to a budget. What's important isn't the budget. What's important is what happened. And so many not-for-profits I've worked with and I've consulted with, they focus so much on the budget and they don't realize that the house is burning, that they don't have any money, or that their operations aren't profitable because they're not looking at what's taking place and what's happening. So I would say take your budget, create it, get it approved by your board, use it as a guidepost, but don't worry about it. Instead, worry about what's happening. Worry about your income statement. Are our operations doing what they're supposed to do? So not-for-profits need to understand this. So let's go back to our formula. And once again, in the income statement, it follows the same kind of formulas. Everything has to balance out. So the left side, the assets, which is the cash and inventory and machinery, they have to equal the other side, the right side, that equity, and that's this net income. And so I want to talk about this because it's really important to understand this next point, to understand accounting. So like I said, this is not about math. It's about trying to understand the value of something. So in accounting, we use two terms. We use the term debit and we use the term credit. So people, doctors, lawyers, the people I was at Loyola with, they tend to think of a debit as something of like a plus and a credit as a minus, because we use this terminology in that way in kind of in the secular world, let's say outside of the accounting world. But actually, it's not like that. It's kind of counterintuitive. So we have to change our mindset in order to understand accounting. So it's kind of like the subparticles in nature. I don't know if you read about subparticles, but they can take all kinds of different characteristics, and that's how a debit and credits are. They can be sometimes a plus. A debit can be sometimes a plus and sometimes a minus, and a credit can be sometimes a plus and sometimes a minus. So it depends on how they're used and in what condition. So let's look again at this formula. So in our balance sheet, assets equals liabilities plus owner's equity. On the left side of this formula, a debit will increase value and a credit will decrease value. On the other side of the formula, it's the opposite. A debit will decrease value and a credit will increase value. Okay, so that's very important. So forget about the fact that it's a plus or a minus or it's this or that. It depends on where it is on the balance sheet and what's happening. So the reason we use this formula is because there was a monk, a Franciscan friar, who came up with this system called the double entry system. His name was Luca Pacioli, and he was a collaborator of Leonardo da Vinci, and he was the first one. I mean, this idea of a double entry system had been around for a long time. I think the Koreans probably centuries, maybe thousands of years ago invented it, but anyway, he's the first one that kind of wrote it down, and they call him the father of accounting. So what's a double entry system? It basically says that one side always has to match the other, that things always have to be in balance. So the way accounting works is always about balance. Assets equals liabilities plus owner's equity all the time. So left side always equals the right side. So that's the same thing with debits and credits. So once again, I said that in the situation of an asset, then a debit increases the value of an asset. So let's say cash, accounts receivable, inventory. If you in accounting use a debit, you got cash, then it's a debit. And so it increases it. If you use a credit, like you use cash, then you would credit it. So that would go against the value of that. On the other hand, in a liability, it works the opposite. A debit will decrease the value of a liability. So let's say that I used, I paid off a note that I owed somebody. Then that would be debited because I would decrease the value of the note. So it's the reverse of the other side of the equation. So now I want to do the same thing and drill down into the income statement. So you got it, assets and liabilities, credits and debits are reverse of one another, and they're just about how we're going to use the double entry system. So in the income statement, it's kind of the same counterintuitive approach. So let's look first at revenue. So let's say that you sell a book or you sell some product. So when you sell something, then you would have to credit that sell, and that would increase your profit, increase your revenue. And instead, if you have an expense, then you would have to debit that. It would decrease that. So just to say that debits on a revenue side decrease the revenue and credits increase the value of the revenue. If it's an expense, debits increase the value of the expense and credits decrease the value of the expense. So it's the same thing as the balance sheet approach. It's just drilled down into the income statement. So I'm going to give you some examples. Okay, so example one, you sell a product. Okay, so cash is an asset and revenue is an equity. It's on the other side of the equation, right? So if you sell a product, then you debit your cash for $100 and you credit your revenue for $100. They balance one another. Your cash value goes up, your revenue value goes up because it's on the other side of the equation, and you have a debit and a credit. Example number two. And this is only dealing with one side of the equation. So I'm only going to be dealing with assets here. So I'm going to purchase a machine with cash. So I purchase this machine, my asset value of my machine goes up. I debit it. But I use my cash to do that. So the cash value goes down $100, and so I credit it. But they equal one another. So once again, it balances out. So instead of using one from two different sides of the equation, I'm on one side of the equation and I'm making it balance. Number three, I'm going to purchase a machine with debt. So I buy that machine. So the asset side of my equation, sorry, I got them reversed. The asset side of my equation, my value goes up. So I debit it. But I'm going to use an accounts payable because I'm going to owe somebody. So I'm on my balance sheet, I'm going to owe someone. So I'm increasing my accounts payable, so I credit it. So maybe I've sufficiently confused everybody, or maybe I've offered a little bit of clarity. And so just to summarize, it's not about mathematics. It's not about a debit is more or a credit is less. It's about a formula. It's about a balancing act in a formula. And so, and I also would like to, even if you don't even understand all of that, hopefully you'll take away that the balance sheet is the most important tool that you have in your toolbox to understand how to be a going concern and run your business. So, and I say all of that because this helps us in the next step of what we're going to talk about. So I'm going to pause here and ask Joe if anybody asked any questions.
So far, you've answered all the questions, but let's give anyone a moment to just ask anything else in addition. No one's raising their hand. So I think you can continue, Pat.
Okay. So that's accounting 101. There would be much more to say, and if you're intrigued by that and you find that totally fascinating, then go take an accounting class. It is kind of fascinating and it is interesting. But I think as a manager or someone who is in a position of running a business or running a section of a business, it's a fundamental thing you have to understand. So it's not something you can say it's accounting, I don't like it, I'm indifferent to it. You really have to understand how to read a balance sheet. And so hopefully this gave you at least a little bit of an insight into why a balance sheet is important and how it's a tool to understand the value of your organization and to plan for the future. Okay, so talking about planning for the future, we go into the next section of our topic. And this is the key elements of organizational structure. So in general, in management theory, there's basically three different ways organizations are structured. So there's your traditional hierarchical structure, which, you know, if you look at the church, it's very hierarchical. You know exactly, for the most part, who reports to who. There's a pope, there's a bishop, there's priests, there's in your parish. And in our organizations, often we follow the same kind of thing. There's the CEO, there's the CFO that reports to him or her. There's different VPs that might report up, and then down through the line, the managers all report, and everybody reports to one another, and that's a hierarchical structure. And so there's a lot of organizations that have been traditionally organized that way, and some that continue to go that way. Starting around World War II, I would argue, the Japanese, actually an American who had gone to Japan after World War II, and with the Japanese automotive industry, they created a kind of a new approach. And it was more of a self-government approach. It was giving people in the rank and file on the line, on the floor, building cars, more power and more governance options. And so they created a whole new way of looking at structures and how things could run and how decisions could be made. And so that's kind of what I would call the self-government within an organization, or a way of working where the power or the decision making is more diffused throughout the organization. And that's something that has now grown in a lot of different ways. If you look at some of the more modern companies in Silicon Valley, for example, this is really used, and it's a model that's creates a lot of creativity and is helpful for organizations to become successful and to thrive. I would argue that most organizations are a combination of these. So they have a traditional hierarchical structure, but they also have a lot of self-governing components. And I would suggest that probably your organizations fit in the combination approach. So I guess the next polling question is, according to you, what best defines your organization? Is it traditional hierarchical structure? Is it self-government? Or is it a combination of the two? So I don't just make my own kind of conclusions. I'll let you decide. So Joe, why don't you go ahead and open up the polling question?
Yep, right now we're half traditional hierarchical and half combination. Give it a few more seconds, see if there's any more votes. I think that's what we're going to get.
Okay.
Traditional, yep, 50% traditional hierarchical structure, 50% combination.
All right. So I would argue that no matter what your structure is, that in order to be successful, you need to have these common things. If you don't have this, then probably there's confusion. So no matter how you're organizing or what you're doing or the combination, in my opinion, These are the commonalities of a successful organization. First of all, you need to know who's in charge. Everybody has to understand how decisions are made, and decisions have to be made. In so many organizations that I know and I'm a part of, there's like at times a paralysis in the decision-making process. And so in order for an organizational structure, no matter how it is done, to work, there has to be decisions made, and there has to be a process for making decisions. So that can be the bishop who decides everything, or that can be on the assembly line, people making decisions as they're working. It doesn't matter what the approach is, but what has to be clear is that everybody understands how those decisions are being made and that decisions are being made. And within that, there's a clear chain of command. So there's an organizational structure where you know who's running the organization, you know how things are being done. Then I think the second thing is you need to understand who's doing what. For example, what do I do? What's my job description? Do I have a clearly defined job description? Do the people who report to me, do they have clearly defined job descriptions? Do they know what they're supposed to be doing and when they're going to do it? Do they understand the workflow? Is there a workflow? Is there a consistency? Do we have a process in place in order that whatever happens, whatever the decision might be, we can implement, we can do our operations and execute effectively? And I think then the third point is delivery. So sales, marketing, distribution, that all has to be clear. Decisions have to be made. People got to know. I think it's Jim Collins who says it's not only important to know to have the right people on the bus, but they got to be in the right places on the bus. So jobs clearly defined. And then sales and marketing and distribution. You know, do we have a well-running machine? Are we able to meet those ways of getting things out there? And then geography, new ways of working. You know, I work with an organization, the DFMC, where I'm in Phoenix and my board members are all over the United States and Canada. And we do everything, you know, with computers, and I can do stuff from home, and I can travel around the world and I can still be connected. So I'm in my geographical location that fits my needs, which is in cyberspace. Whereas when I worked at the USCCB, they mandated that we went to work every day, that we had to go to the building, that we had to be a part of that, because what was important in that world was the interaction, the way people work together to get things done. So I needed to work with the other departments. They needed to know what I was doing. And so there was a real need for a geographical location. And so I think these are some of the common needs that we need for an organization, no matter what the structure is, to be successful. And I want to go into a moment with sales and marketing, because it's so often the case that there's friction between these two, because I was a marketing director at one point, and I certainly had done my share of sales over the years. And so there's always a kind of, I would say, a tension between the two. And that can't be. We need clearly defined chain of command. We need jobs well defined. And everyone has to know their place in the organization and realize that they're a valued part of it. Which leads me to my next point. We're going to go towards organizational efficiency. So how do you move from that, whatever organization you are, that has all those common traits that are thought through and working, so you're creating teams, and then how do you move towards efficiency? So I would argue that efficiency has these characteristics. How are people treated? So whether it's your board members, your rank and file, your employees, your managers, how are we treating people, and how they're the, you know, people are our most important asset. No matter, as an accountant, when I look at that balance sheet, I see that the biggest expense in almost any organization is in people. I mean, that's where we're putting our money. That's our resource. It's not necessarily our machines or even our inventory, although those are big ticket items. It's the expense item that's the biggest every month is our payroll. And if you look over a number of years, that's an enormous expense. So are we really invested in that? Are we doing training? Are we compensating correctly? Are we recognizing the needs of people so they can be creative and that they can be a contributing part of our organization? So I think that that's a fundamental part of organizational efficiency. If people the morale is good, people are happy, then you're going to be a much more efficient organization. The other thing that fits into that is communication. in today's world, there's so many different ways we can communicate. There's so much that it's almost too much. It's almost overwhelming. So there has to be a way an organization has to figure out how it's going to communicate, how it's going to operate those lines of communication so that everybody in the organization understands what they should be understanding. It's communicated to them in a way that they can use it, and it's communicated in a clear way. So we have using technology. When I was at the USCCB in our publishing area, I had a staff that was dealing with people that would call to order items or call to complain. So we, our customer service staff. So we created, using a social app, we created a way where they could communicate with one another and with me in real time so that we could make sure that the customers that were calling were assisted in the best way. So that was a use of communication that empowered the staff that was in the customer service area. So they felt like they were giving people solutions right away. That helped their morale go up, but it also helped our efficiency go to a higher level. And then the other thing I think that's important to keep in mind is that going back to the decision making. So is it clearly identified who should be making the decision at what time? Do we know what the levels are? If something is to go wrong, do we have a plan in place so that conflicts or problems can get resolved right away? Are we delegating authority correctly? Am I the executive director, so I have all the authority and only I can make the decisions? Well, that might not be the most efficient way to run an organization. Probably it's better if I delegate to the proper person, and that person then I have to make sure that their job description is written in a way that they can actually have that delegation, that they're being compensated correctly. Otherwise, it'll hurt the morale, and I won't be, in a way, working with my employee in a respectful way. So, am I delegating correctly, and do I have things well defined so everybody knows what should happen and when it should happen? So that's a couple of ideas that I think that help organizational efficiency. And now I'm going to go into some of the things that I think are just like practical ways to improve efficiency. So if on any of these former things you say, well, we're really lacking there, or we don't have that, or we could do better, here's some practical advice I found that might be helpful. And so there's a company called Paycor. Some of you know them, and I'm not advocating for them or anything else or their products. But I just found some of the stuff that they have to help companies useful. And so I borrowed some of their ways to work with organizational efficiency to share that with you today. And so the first thing that really struck me that they talk about, and in my organization, in fact, we had Paycor come out and do a presentation to our membership last year, and I found it really helpful. So that's why I turned to them. So one thing is that you need to streamline your processes. And we're going to talk in a minute, a little bit further on, about core competencies. Like, is it clear to you and to all of your employees what you do and why you do it, what your core competencies are? I remember when I was at Loyola, what impressed me about that institution and Jesuit institutions in general, I did some studies at a couple of others, is that the professors that I had throughout any time I've been in a Jesuit institution, they all understood whether they were Catholic or not Catholic. I mean, I had professors that were Jewish, some, I don't know what they were. They all knew that they were at a Jesuit institution, and they all bought into the core values, and they could tell you what they were. They could express those in the way they taught. So that always impressed me as a real clear, an organization that really had clear ideas about who they are and what they were doing, and it went all the way down through their employment. I was just at Creighton 2 weeks ago, and I saw the same kind of thing. And I'm not advocating for Jesuits either. There just happen to be a couple of universities that I have been in touch with. But I think that identifying your company's core competencies and then making sure that everybody buys into those and knows about them and is a part of them. Then other things like, what's your workplace processes? Look at them, maybe map them out. I was working with the American Nurses Association once, and we did what was called an ISO chart. So ISO is a way of looking at all kinds of processes and writing them out and figuring out if they're good or not good. So there's a whole way of doing ISO. But we did that there, and it was really helpful to take away processes in their operations that were not being efficient and not adding value. And it helped us to also add some that were missing, like certain things that were being missed in their business work. And then you need to benchmark. You know, people need to know what we're going towards. I mean, why not only why are we doing something, but what we're doing it for, where we're going with it. And then, like I said before, when I was talking about the ISO, maybe there's inefficient processes, things that need to be changed, and then maybe make a list of things. So that way you can streamline your processes. And then if there's any systems that are old when you're doing that kind of work that don't work anymore, you know, it's time to move on. It's time. We're in a fast-paced world. I know that technology can be very expensive, and so it takes a lot of thought to determine what you should be doing and how you should be doing it. But it's fundamentally important for the success of an organization to continually look at your systems. And the third one is, and this goes back to the communication piece, can people, if you have something to communicate, how is that arriving at people? Can people access information? Are there predefined ways that we should operate? Does everybody know about that? Another thing, when I was at the USCCB, I was on a work group once to see if there were ways we could make the work we were doing at the conference more efficient. And one of the things my group, I had the communication work group, was we realized is that there were all these policies and procedures everybody told you about, but nobody knew what they were. There wasn't like a single place where you could go and look at them, although we had employee handbooks and everything. There were all these kind of like hidden rules. And so we suggested that they create a website where all of the different departments or all the different committees could actually put what their rules were, what their procedures were. And so to this day, 12, 13 years later, there's still that internal website where everybody can access all of the information they need to get their work done. So making information easily accessible. So I want to go from efficient organizations to effective organizations. So in my opinion, what makes an effective organization? So efficiency is great, and you can have all these processes and everybody can be on it, and your operations are really good. And I would say that's kind of like what I said before, that's like your income statement approach. You know, how did we do last month? How did we do last year? So we're very efficient. So if we want to move to an organization that's effective, I think we need to take a balance sheet approach. So we need to go from just what did we do and how great was that, and was it within our budget, to, okay, what do we have? Who are we? Where are we going? What's our future going to look like? What are we going to do in 2 years? What are we going to do in 5 years? Do we have the resources to do that? And so I would say for an organization to be effective, we have to ask ourselves, is my organization doing the right thing? Are we thinking strategically? Do we know who we are? Do we know what we're really wanting to do? There's a TED Talk that I use with my board of directors, and I highly recommend it. It's by a guy named Simon Sinek, and it's called Getting to the Why. And Simon talks about the great companies or the great moments in history that were really successful. And he uses, for example, I think Apple is one of them, and the other one he uses are the Wright brothers. And so he says, what made the Wright brothers so successful? There were other groups trying to put a plane into flight, and a lot of them had a lot more resources than the Wright brothers had, but they weren't successful. Why were the Wright brothers successful? Because for them, it wasn't about building a plane. It wasn't about making even money doing that. They had a more fundamental why they wanted to do that. They had a passion for flight. They had a passion for doing something incredibly forward-looking. And so that passion was their why. Or he looked at Steve Jobs and said, you know, for Apple, it's not so much about a product, it's about an idea. It's about a creative idea of the future that people can buy into. So I got my Apple iPhone because it's so cool. So I became a part of not a product, but I became a part of a why, of something bigger than me. So I would say that for your organization, you have to do the same thing. It's not about what you do or how you do it so much. It's about why fundamentally are you doing it, going back to your core competencies. And I would say this is a balance sheet approach. So when you're doing this kind of thinking, of course, you get into your strategic direction. So we all do strategic plans. If you don't, you should. Please do a strategic plan. And so there's two, in my opinion, in my experience, there's two different ways of approaching strategic plans. For years, I was with organization and we did what I would call activity-based strategic planning. And so we would look at our activity, we would do our mission statement and our vision, and then we look at all of our activities. And then in that way of looking at things, what are we going to do? What are we going to do? How are we going to do it? The process is really important. The planning process is important. And we spend all this time invested in a planning process. We don't really get too much of the implementation done well, but we really had a fun time planning. And maybe we're successful, maybe we're not. And we're focused just on our activities. What I've found that's more successful is not being focused on activities, but being focused on performance. And this goes back to what I said before. If you're looking at your income statement, then you're looking at what happened last month. What was that activity? Did we sell more books? Was it successful? What about that latest launch? And that's important, and you need to do that. But I think you got to step back and take a bigger picture at your strategic plan. And you got to focus on the outcome, on the end. Like I said before, you don't focus on the budget so much as what happened. Why did it happen? How can we improve tomorrow? So I would go from a process kind of an approach to a solutions approach, or a results approach, to realize that it's not so much our process that has to become institutionalized, but our results should become institutionalized. The things that work need to continue to move forward. The things that don't work, we have to completely abandon. And so what is a performance-driven transformation, I would call it? When you're strategically thinking and planning, thinking about performance, not an activity, what does that look like? What does a big picture approach look like? A balance sheet approach look like? Well, you don't spend a lot of time on looking at just the activity that you're going to do and focusing on it. You look more at, let the activities that are working go, and the ones that aren't working that might need attention. And so you focus on those things more. You start focusing on your processes, on your steps in a bigger way. So what do we? I think that's another thing that Jim Collins says is, do you have a list of the things that you're not going to do anymore? So it's important to have a list of the things you're going to do, but you need a list of the things you're not going to do. And in order to understand those things, I think you have to look at performance. What's performing? What's getting, not the activity, but the performance? What's bringing in results? What's results based? And the things that aren't results based need to be either relooked at, because maybe they need to be adjusted, or maybe they need to be abandoned. And then when you do that, your results based, you're looking for quick wins, things that can get you to the next step right away. And some people would call that even like low-hanging fruit kind of an approach, and get the quick wins in because you're based on performance, not so much being tied into a certain activity. And this gives you a lot of more freedom in the way you run your organization. And then once you have that why, and that why leads to looking at performance, then we can focus on the what and the how. And that can help us to develop more realistic long-term goals and objectives, because we're looking at what are the results going to be, what's going to get us there, not just the things that we've always been doing and we always did it that way, but instead, where do we want to be and what's going to help us to get there. So we translate our strategic objectives into short-term improvement projects. So just to, then you go from the what to the how. So just to kind of give you an idea, I did a strategic plan with my organization, with the DFMC, and the board identified different activities it wanted to do. And so I applied the performance approach to it. And one of the activities that they wanted to do was that we should develop a mentoring program between the members. And so that was an activity that got to a bigger objective and goal that we were trying to reach. In the process of doing that, we reevaluated and we said, well, that's actually a great idea, and maybe one day we'll get there, but it's not really offering us value right now. And in that process with the communication on strategic planning, we actually realized that instead we had this certification program that had incredible value and potential, only that we weren't utilizing it correctly. And so we rethought the whole thing. And we actually worked with Villanova, University of Villanova, and developed a stronger, more robust certification program. And it wasn't one of the things that we had anticipated. So we went from looking at the activity. If I would have got tied into, they wanted me to do a mentoring program, so I have to do the activity. then I would still be working on that, trying to, drudge through it and get that done. But instead, we were able to look at the performance and the results and say, that's not getting us where we want to be. We looked at something that wasn't performing, and we were able to transform that into something that's now getting us to where we want to be. So don't be slaves to activities and processes, but instead continue to look at results and performance and where you want to be. So I think my time is up. I want to stop here and see if there's any other questions or any other concerns anybody had. So Joe, I'll hand it over to you.
Excellent. Well, thanks, Pat. Yes, if you have any questions, please type it into the panel on the right-hand side. No one has their hand up yet, but we will see if we'll give it a minute here. Yeah. While we wait to see if there's any additional questions, let me at least announce that we are currently planning our next year worth of webinars. We do know that the next one will be on October 15th. The topic, though, is still to be determined as we are trying to finalize the entire slate of the schedule. We want to remind you that once we end this webinar, you'll be receiving an email with a short survey, including what topics you would like to hear. So please do make sure that you fill that out. Pat, I think you did a great job because I'm not seeing any questions. Anything that you want to make sure that we leave or know? Anything else?
Well, I think from just the accounting side, my message is, if you want to be a successful leader, realize the power you have in your accounting tool, which is the balance sheet. It's a tremendously powerful tool. And even if you don't do accounting, you have accountants that might report to you. And so you better know that and the power that you have with that. And then I would say that leads you, thinking in those terms, will lead you to think in a way that's efficient, effective, and will help that your organizations hopefully to thrive and succeed. So hopefully that's what you took away from this.
Excellent, thank you. Well, in the chaos of our starting, I completely forgot to lead us in opening prayer. So how about we end in prayer today? Let's take a moment, though, to keep in mind all those who are enduring the earthquakes on the West Coast, who are dealing with the heat throughout the summer, and those that are in the path of the what looks to be Hurricane Barry by this weekend, and anyone else. And especially, though, also we want to pray for those, as we've been talking about finances and accounting and stewardship and everything, those that just simply do not have enough. So let's just take a moment to keep those in mind, and then let's pray together the prayer that's on the screen. O Lord, giver of life and source of our freedom, we are reminded that yours is the earth and its fullness, the world and those who dwell in it. We know that it is from your hand that we have received all we have and are and will be. Gracious and loving God, we understand that you call us to be the stewards of your abundance, the caretakers of all who have entrusted to us. Help us always to use your gifts wisely and teach us to share them generously. May our faithful stewardship bear witness to the love of Christ in our lives. Pray this with grateful hearts in Jesus' name. Amen. Thank you again, everyone, for joining us. Please look forward to that email. And on behalf of ACP and Ministry Training Source, I thank you for joining us and wish you a great rest of your day. God bless.
Thanks, Joe.